On April 1st, 2026, the Reserve Bank of India intervened in the offshore currency markets. They instituted an immediate position cap on banks, which forcibly unwound at least $30 billion in active arbitrage trades over the next 48 hours. The sheer volume of that forced liquidation caused the Indian rupee to gain 130 paise in a single session. That is the currency's largest single-day gain in 12 years, driven entirely by the unwinding of offshore derivative positions. To arrest the volatility, the central bank had to prohibit authorized dealers from offering the specific contracts driving the volume. They banned an instrument that legally exists outside of their own jurisdiction. This equation defines that instrument, the Non-Deliverable Forward, or NDF. It is an over-the-counter forward contract on a restricted emerging market currency. Two parties agree on a future exchange rate, and at settlement, they calculate the difference between their agreed rate and the official spot fixing rate. The critical feature of this math is that the profit is paid entirely in US dollars. No physical local currency ever crosses a border. There is no domestic custody, and therefore no local regulatory approval required to execute the trade. Because of this frictionless structure, the Bank for International Settlements notes that between 60% and 80% of all NDF trading is purely speculative. By April 2019, data from the BIS Triennial survey confirmed a structural inversion in global finance. The volume of offshore trading in emerging market currencies officially exceeded the volume of onshore trading. The offshore derivative ecosystem is now larger than the domestic markets it was built to shadow. Sovereign states with restricted capital accounts are now permanently exposed to an offshore market architecture they cannot control. The oldest documented use of this structure is the directional speculative attack. A fund isolates a country maintaining an indefensible managed exchange rate and aggressively shorts the local currency by buying US dollars via 6 to 12-month NDF contracts. Stanley Druckenmiller outlined the specific sizing logic for this trade in his assessment of the European exchange rate mechanism, which set the template for every emerging market currency attack that followed in the late 1990s. This matrix models the math. A fund expects a massive devaluation. To hold the short, they pay a forward premium of roughly 0.5%. Because this cost is a rounding error compared to the payout, conviction isn't the limiting factor. The only constraint is capital. Going into the summer of 1997, Soros Fund Management and Julian Robertson's Tiger Management applied this exact scaling logic against the Thai baht. Between them, they built a documented $4 billion short position utilizing forward contracts. The Bank of Thailand exhausted its reserves attempting to defend the peg against this capital weight. They failed. By October 1997, the baht had depreciated 60% against the dollar, paying out directly to the holders of those forward contracts. When the cost of holding a forward position is structurally lower than the expected policy collapse, macro funds will relentlessly scale their exposure. The target sovereign breaks under the sheer mathematical weight of the capital. Beyond directional attacks, funds use the NDF to harvest extreme emerging market yields. High benchmark rates, like Brazil's Selic rate reaching double digits, offer massive interest rate differentials. Funds extract this via unfunded carry trades without ever touching a domestic Brazilian bond. This flow diagram maps the process documented by the BIS. A fund borrows Japanese yen at 0.1%, converts exposure to Brazilian real, and utilizes offshore NDFs for a 14% yield. This nets an 11.9% annualized return. The risk is entirely symmetric. Because the exposure is unhedged, a single sudden political shock that drops the real by 5% will wipe out months of accumulated carry yield in an afternoon. To eliminate directional risk, funds use basis arbitrage. Capital controls split the liquidity pools, so the offshore NDF frequently prices the currency differently than the onshore deliverable forward. By simultaneously trading both markets, a fund earns the spread risk-free. This bar chart measures the gap. According to 2025 IMF data on covered interest parity deviations, pricing inefficiencies in emerging markets are consistently 10 times larger than in advanced G10 economies. 10 times wider deviations mean 10 times wider arbitrage windows. This persistent structural gap is exactly what incentivized foreign banks to build the $30 billion powder keg in the Indian rupee. The architecture of the NDF contains a highly exploitable bottleneck. Because no physical cash changes hands, every active contract must settle against a single official reference rate, published at an exact time. For the South Korean won, that reference is the KFTC 18 rate, published daily at 9 a.m. Seoul time. London-based funds trading won NDFs structure their entire multi-million-dollar order books around that exact minute. This timeline plots the resulting order flow. Market participants with NDF exposure crowd the market minutes before the fix, squaring their books and concentrating immense buy or sell pressure precisely when the reference rate is being calculated. Central banks actively track this behavior. In a 2016 speech, the governor of Bank Negara, Malaysia, explicitly stated that non-resident financial institutions were intentionally using these fixing orders to manipulate the offshore NDF reference rate in their favor. When an instrument's payout is determined strictly by a mathematical fix, aggressively manipulating the order book in the minutes before that fix is published becomes just as profitable as correctly predicting the macroeconomy. The conventional assumption in finance is that offshore derivatives shadow the true onshore domestic market. The data from actual market crises proves the exact opposite. This chart plots BIS and IMF findings regarding the 2013 taper tantrum. During high volatility, the offshore NDF market aggressively priced in large depreciations for the rupee and rupiah well before the onshore spot market reacted. The shadow market leads price discovery. Funds positioned in that offshore liquidity capture the move first. Discovery Capital Management generated a 27.5% return in 2013 by shorting emerging markets, specifically through these leading offshore instruments. But the funds generating this alpha relied on settlement infrastructure managed by a highly concentrated group of prime broker banks, and those banks were extracting their own yield directly from the underlying mechanism. In 2015, the CFTC issued a $400 million settlement order detailing how dealers manipulated the CME EMTA rate, which was the primary fixing source for Russian ruble NDF transactions. Regulatory documents outline private chat rooms where traders systematically coordinated their indicative submissions to manually lower the fix by a few kopecks, artificially altering the settlement payout. This cartel conduct resulted in hundreds of millions of euros in fines from the European Commission. Within this ecosystem, hedge funds that independently modeled fair value fixing rates held a definitive structural advantage over the market. Funds that blindly relied on dealer-submitted fixes were systematically extracted for yield at settlement. Alpha generation of this magnitude eventually creates positions so massive that they warp the domestic markets they shadow. When that threshold is crossed, sovereign central banks deploy aggressive containment measures to survive. The first tier of response is the infrastructure freeze. During the 2002 crisis, Argentine authorities called an unscheduled 3-week market holiday. The legal infrastructure determining the settlement rate collapsed, leaving offshore funds with correct directional shorts trapped in contractual limbo. The second tier is architectural redesign. In 2016, rather than freezing the market, Malaysia completely replaced its dealer survey fixing mechanism with hard transaction data, structurally eliminating the timeline manipulation that offshore funds relied on. The final tier is the outright ban, executed by India in April 2026. The Reserve Bank imposed a strict $100 million net position cap on banks and fully prohibited authorized dealers from offering NDF contracts to corporate clients. This chart displays the Rupee forward premium curve in late 2024. The massive weight of offshore arbitrage flow had inverted the entire curve into negative territory months prior to the crackdown. The warning signs of a distorted market were mathematically visible long before the intervention. The ultimate rule of the shadow market is simple. When the offshore derivative tail wags the onshore domestic dog too violently, the sovereign is forced to break the market architecture to regain control. Despite aggressive sovereign responses, the alpha in this market continuously regenerates due to 3 structural realities. First, capital control asymmetry. A central bank can heavily restrict its domestic onshore market, but it lacks the jurisdiction to policing cash-settled contracts executed in London or New York. Second, information opacity. Prime brokers possess real-time visibility into global order flows, while central banks must rely on delayed surveys to estimate offshore exposure, ensuring the market maintains a permanent informational advantage over the regulator. Finally, policy-induced mispricing. As long as sovereign governments mandate unnatural capital prices by maintaining indefensible currency pegs, they offer the market a one-way bet. Prohibitions like India's $30 billion unwind do not destroy the trade, they merely crystallize the profit. As long as emerging markets enforce capital controls, the offshore shadow architecture will adapt, evolve, and violently reprice them.